Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our periodic commentary on economic and market events. Let's get started. This week's Market Insights comes in spring colors and spring allergies. So be forgiving, I'm kind of in a antihistamine fog. Having said that, there were two seismic economic events last week that I'm not sure everyone quite understood the significance of them. So, first big headline grabbing event, I guess in terms of importance, not chronologically, was the release of the first quarter GDP. It was a shocker. The economy dropped 1.5%. Now, it didn't actually drop 1.5%. That's the headline, but these numbers are annualized. So the economy actually shrank about a little less than 0.4%. That annualizes into 1.5%. So if this keeps happening for 3 more quarters, the overall economy would drop by 1.5%. That's how the numbers work. All right. That, if we get one more quarter like that, that constitutes officially a recession. And that was initially very, very alarming to investors. And then after a moment or two, they said, well, wait a minute. If the economy is weakening like this, then that means the Fed might slow down their interest rate increases, might slow down their money unprinting program, and that would be really good for financial markets. And so people went from being scared to being happy, and markets went up, at least as of this recording. Now, I will suggest that the Federal Reserve is going to look through these numbers, and they are not going to be scared in the least. And you can say, how can they not be scared at the prospect of being on the precipice of a recession? I think when you look underneath the data, the GDP numbers suffered a lot more than the US economy. Let me explain why. The biggest thing that pushed down GDP was a massive increase in our trade deficit. And trade deficits are a subtraction from GDP. Exports are an addition to GDP. That's how the math works. When we import stuff, the economy is smaller. When we export stuff, the economy is bigger, according to the GDP equation. All right, so huge surge of imports is automatically going to tell you that the economy is getting a lot weaker. And normally there'd be an offset to this, because all that imports, you can't sell it right away. It's going to go onto store shelves and the inventory is going to go up. And so what goes down in the trade goes up in inventories. Net, everything's good. But US consumers were pretty aggressive in their spending patterns in the first quarter. So they actually purchased a lot of the stuff that was coming in from China. So that meant that there wasn't a whole lot of inventory. As a matter of fact, inventories went down. We not only purchased all the imports coming in from China, we actually purchased a lot of the stuff that was already on the shelf. So inventory net went down. That's a 1-2 punch to the economic growth. Add on to that, you're having continued production problems in some of our major industrial strength sectors like autos and airlines. Boeing continues to have difficulty with their 787, and they're a big part of GDP. And so all those things added up to the grim number that we got. So there are 2 conclusions that we should draw from this. Number 1, tariffs don't work. We put in place tariffs in 2019, and the trade deficit has done nothing but get worse since we did that, with a brief little improvement when COVID was at its worst and China wasn't making anything for us to buy. Our trade deficit with China has gotten worse despite tariffs because a mercantilist economy dominated by dictatorship, like China, They just manipulate their way around the tariffs. They increase subsidies. They manipulate their currency. Net net, the impact of these tariffs has been actually the trade deficit's gotten worse since we put them on. All right, contrast that with what happened when President Reagan put quotas on Japanese car imports. Within a few months, you started getting announcement that Honda was going to come to Ohio, and Toyota was going to California and Kentucky, and Nissan was coming to Tennessee. Huge difference. How many iPhones are being made in the US right now? None. How many are being made anywhere outside of China? None. Tariffs don't work against a dictatorship mercantilist economy. Quotas do. One of the greatest things Biden could do is eliminate all of Trump's tariffs, because that would help with the inflation we got going on, and put quotas on China. I won't hold my breath. Second conclusion is that while the number is scary, the actual underlying data, not so much. It's basically saying the US consumer's in pretty good shape. Despite the inflation, despite a war breaking out, we continue to spend. But there's nothing like a good old American consumer. That has been one of the strongest bedrocks of the global economy for 70 years. And it's been proven so again. So if I were the Fed, I would look at the underlying inflation data, which was absolutely horrible, and say, that's more important to me than the minus 1.4% growth. I think the minus 1.4% growth is just a temporary thing because of the big surge in imports and so on and so forth that we've talked about. That inflation, that's not going anywhere. And so I think this has probably increased their resolve, not lowered it, to increase rates 50 basis points at their next meeting, and to continue unprinting $95 billion a month. And we should note, the Federal Reserve has never unprinted $95 billion a month. The most they've ever unprinted was $50 billion a month, and that was in 2018 and 19. We saw a stock market crash in 2018 and a bond market collapse in 2019 in September. And that's what got the Fed printing money again, was that bond market collapse in September of 2019. So there is a lot of risk. The market is currently saying, yay, the Federal Reserve is probably going to give us a break. I'm skeptical of that view. All right, so that's the bad news. The good news, especially for long-suffering American consumers at the pump, is that last week, Rosneft came to market to sell their oil. That's the big Russian oil company. They came to the market to sell their oil. And they had a little twist this time, a new condition. Friends, our dear patron Vladimir Putin has informed us that we must require you to pay in rubles. Otherwise, we will soon be drinking radioactive tea. They didn't say that exactly, but that was the basic message. We have a gun to our head. You have to pay us in rubles. We can't accept anything else, or we're going to make Vladimir mad. And basically what happened is the entire auction of their oil failed. Nobody bought a barrel. And do you know what energy markets did? Do you know what oil markets did? Nothing. Oil prices really didn't change. Russia then cut off gas imports to Poland and Bulgaria. And energy markets did, natural gas prices went up, oil markets didn't budge. And then today, or last week, Germany announced that they were so upset that Russia is trying to basically blackmail Europe with natural gas, which, by the way, is anyone besides the German leadership surprised that that's how things turned out? But Germany has decided that they are so upset with that they have thrown their support behind an embargo on Russian oil, that Europe would just quit buying it. And do you know what oil prices did? It went up 1.5%. What does that mean? I think it means that oil markets have pretty much so fully priced in the elimination of Russian oil supply to European and other Western markets. They're really priced for the worst case scenario already. And for those of us who have really suffered, I've got a truck, oil prices went from about $30, $35 last April to about $70 by December. And that was probably because, not probably, it's because we printed too much money. All right. But some part of the move from 70 to 100, 105, that's the war in Ukraine. And that move may be over. The market may be ready for the consequences of this war on Western energy markets because it got two big shocks last week and it was not disturbed. And that may mean that no matter how bad and how tragic and how horrible the Ukrainian people suffer, and no matter how extended and awful this war becomes, global consumers may have already taken most of the pain.
What is the difference between a quota and a tariff?
Oh, probably should have explained that. So a tariff is where you put a fee, a tax, on the purchase of an import. So if the import was going to be $100 and you put on a 20% tariff, you're now going to have to pay $120 for that import. And the way that the Chinese Communist Party can manipulate their way around that is they subsidize all their industries, they subsidize them another $20. Or usually it's a combination of increased subsidies and then we're going to undercut our currency and drop it relative to the dollar about 10%. And then net, you offset the tariff. So that's a tariff. It is a tax applied to the purchase of a imported good. A quota is a numeric count of the goods that you are allowed to import. So you are allowed to import 5 million iPhones. And instead of we're putting a tariff on and that should discourage people from buying your iPhone that you can manipulate around, basically when you get to the 5 millionth and one iPhone, sorry, you're done. It's fairly impossible for even the most mercantilist economy to manipulate, which is why back in the 80s when Reagan put them in place, Japan very quickly threw in the towel and said, okay, let's start building factories in America. There's no other choice. So now if you talk to economists who have guaranteed jobs at a college, they'll tell you, oh no, quotas are terrible because they distort, this, that, and at least with a tariff, the price mechanism can adapt. And what they're failing to recognize is we're not talking about a free market exchange when you're dealing with Japan in the 70s and 80s, when you're dealing with China currently. China is copying Japan's playbook from the 60s, 70s, and 80s. And so that's why they are very good comparable situations. And Japan manipulated around every attempt we made to keep their imports to us down. They manipulated their way around it because they were unified. They weren't a dictatorship, but they were a one-party country. The LDP won every election, still do. And China is a one-party country that is a total authoritarian dictatorship, and there are no elections, so they win them all. And with that kind of unified vision, it's very easy to manipulate your way around a tariff, but it's impossible to manipulate your way around a quota. And that's why if you're dealing with a mercantilist economy and you want to get your trade deficit down, don't waste your time with tariffs. Do a quota. Thank you for joining us for Market Insights. We hope you found it informative. If you did, we hope you can like the video and share it with your friends. If you'd like to see more of our research or you'd like to learn more about our powerful investment planning and asset allocation software, please check out our website, caravelconcepts.com. Thanks.